What is up, my gamers? Welcome to Let's Play Fortnite. I guess that's not what this stream is about, but hopefully you see that I've got some pretty sweet gaming headphones now. Hopefully the audio is coming through much clearer. Last week I realized the audio was not the best, and so I decided to grab some of these headphones to make sure we have a clear audio. Make sure you understand what I'm saying and that it's not a terrible, terrible experience to go through this, because I did not like how that went last week with the audio. Man, this week has just reminded me of a little more than 10 years ago when the 2008 recession was happening. Let's see, this wasn't quite the full force of 2008, and it was about like February, March, something like that. And I don't know if you know so I was on a trip in Florida at the time, and I wasn't really tuned into the news that much. I was focused on a few other things, and so I would go around, I'd talk to people, and I'd introduce myself, and I was introducing myself by my last name, and people were like, wow, Paulson, like, we're hearing that name in the news a lot right now. And the reason why is because the Secretary of the Treasury at the time was Hank Paulson, and the recession was starting, and so people were talking about Hank Paulson all the time and what he was doing in companionship with Ben Bernanke, trying to figure out how to address the economic situation that was arising. And all I remember, I had no idea what was going on at the time, except for the fact that Paulson apparently was a name in the news. And now I know, and now I've just been following what's been going on intensely to try and make sure that I'm up to date, and especially so that way I can talk to you about what's going on. Now, today, we're not going to talk strictly about what's going on in current events, but you're going to see how much this connects to it. And hopefully you'll see the contrasts between the Great Depression and what's going on today, and that today is a very different situation. So with that, I think we will get started. There are only 82 people on the stream right now. Hopefully the other students will come on eventually, but we're not going to be waiting for them. We need to get this started. We are going to talk about the Great Depression. And no, I do not mean how you're spending your Friday nights or your time in self-isolation. We're talking about the big event. One of my favorite parts about this picture, actually, I don't know how easy it is to tell. If I zoom in a lot, can you kind of see right around that bottle? That is actually a beer bottle, but I didn't want to promote alcohol consumption, so I photoshopped in a Sprite bottle. Hopefully you appreciate that. I do this stuff for you guys, okay? So let's get into some kind of just basic facts about the Great Depression before we even get lecturing on what caused the Great Depression. That's what we're going to be really focusing on. This is an iconic picture from the Great Depression, because you have all of these people standing in line. I believe it's a bread line, some sort of welfare line you have right here. And yet right there at the top, you see splayed across, world's highest standard of living. This is in the middle of the Great Depression, and you have, I guess it's not quite the middle. You can see the date down at the bottom. It's 1937. But here you have the world's highest standard of living, and yet people waiting for welfare. It's just kind of this stark contrast between what America had been at one point, which we'll talk about today, and where they were at this point. To give you some context for what the Great Depression is, there's the Great Recession in 2008. You've lived through this, right? You're familiar. You've experienced this. We're going to go into depth about this at the end of the semester. But let's start by just thinking about that thing that you lived through. Output, GDP fell by 4%. And at the peak, unemployment hit 10%. That's pretty stark. You remember suffering through that or having family that suffered through that. I will tell you experiences that I remember from going through this. It was a dire time. But when we go back and we look at the Great Depression, We're looking at output falling by 29%. Investment fell from 15% of GNP to less than 1%. And unemployment hit 25%. I cannot even fathom these numbers. These numbers are beyond my comprehension. Like 10% unemployment was bad. 25%. That's 1 in every 4 people looking for a job cannot find one. That is crazy to me. Now, people are worried about where unemployment is going today. I'm not sure. I haven't seen predictions. I'm seeing in the chat that people are saying it's been forecasted to hit 20%. I'm not sure. Some people might be going towards unemployment to try and go through these hard times. We're going to have numbers in a few weeks to know how things are evolving. So we'll keep an eye on those, and as they come up, we'll talk about it. But wow, it is crazy to me to try to even understand the severity of the Great Depression. Something that we can't understand. And I know it feels like right now we're going through some pretty tough times, but we're going to see some comparisons, some contrasts. And as these things unroll, you'll be able to compare it for yourself to see how are things going today compared to these numbers that we saw during the Great Depression. Here's another way to look at it. Here is real GDP from, I don't know exactly the start of this. It's not quite 1900. It's about 1910 all the way up to 2000. And you can clearly see the Great Depression in here. What I think is interesting, let's take those first couple of years and let's just draw a trend line through it. That's the line that most efficiently summarizes those numbers from the beginning. And then let's just extend that line out all the way to the rest. Let's ignore all the rest of the data and just project this line based on what happened right there. And what we see is that with the exception of the Great Depression and that recovery during World War II, this line just fits real GDP over the past century pretty well. It's remarkable how well this line fits it. And so one encouraging thing for you to think about right now is, yes, you have that dip in GDP right there during the Great Depression, but that recovery and the long run economics, it looks like we're pretty on track for where we would have been had we not had a Great Depression. Those kind of counterfactuals are hard for us to acknowledge or analyze, but there's some long run good news when we look at these kind of graphs. I see in the chat there's a question about the difference between GDP and GNP. GDP is gross domestic product. That's all things produced in the economy. GNP is gross national product, which is all income earned by people who are Americans. So this could be income earned even outside the United States. They're essentially the same thing. We make distinctions, especially historically, when we don't always have accurate measurements of GDP and GNP. For the purposes of this class and just generally, you can kind of think of them as about the same thing. Of course, there are nuances there. The nuances are not fine enough for me to actually care for the distinctions in this class. So the value proposition of today's lecture is that by the end, you will understand some of the primary causes of the Great Depression. Now, let me confess to you right now about doing this live stream. When we're in class, when we're in an in-person lecture, there's just a few of you there. Let's admit it, you're probably going to forget most of what I said by the end. And I don't feel like it's very high stakes. I want you to understand what's going on, but if you don't, it's probably not that high of a cost. However, now that I'm streaming this, now that this record is being put out there, and I know that there are people not in this class watching this, I feel a little anxious coming into this lecture. So I say the primary causes, and by no means do I want to say the only causes of the Great Depression. And I know that I'm going to leave out some things. I know that there's probably somebody watching this saying, oh, but you didn't talk about this, or what about that? I'm sorry that I didn't talk about everything connected to the Great Depression, but I hope that by the end you're going to have a fairly good understanding of what happened at the Great Depression. And you're also going to understand how the Federal Reserve affects the economy. Now let's take a step back for a second. Normally, I start off this lecture when we're in person and I can actually get very active feedback. I'll say, what caused the Great Depression? And I throw up those numbers: 25% unemployment, a decrease in output by 29%. Wow, look at all of these crazy things that happened. This is one of the most significant events in the history of the world, at least in the past century. And yet, we usually don't have a very good explanation for what happened. Explanations range all over the place. People might mention a few things. Oh, like something like tariffs is out there, stock market, all these different things. But it's amazing to me how little we understand this enormous event in American history. And even to just pin down a few of the main causes baffles me. When we talk about whatever economic effects happen today, in 100 years, we'll be able to say, oh yeah, there was a big virus that came through and there were fears and people self-isolated. We'll have like a pretty succinct story of what happened. With the Great Depression, I don't feel like most people have a good understanding of what happened. In fact, I feel like what you might hear are just crazy, wild stories that are nowhere near what actually happened. And so this is a really important lecture for you to understand a key piece of American history, of world history. And so I hope that we're in this together. I hope that you stick through for the whole lecture, because we're going to make sure that you have a really good understanding of the Great Depression, at least a bunch of the highlights that will help explain what happened. To start off, what we're going to do is we're going to go over real versus monetary policy shocks, and we're going to talk about the role of the Federal Reserve. Then we'll move into the 20s, the 1920s, not the 2020s, and then we'll go into the actual 1930s and the Great Depression. We're going to talk about three main causes of the Great Depression. Let's start off with real versus monetary policy shocks. Real shocks are sudden changes in inputs, like labor, capital, or ideas. So the example that I commonly give is the earthquake that hit Haiti in 2010. You probably remember that. It's been over 10 years since that happened. That earthquake destroyed Port-au-Prince. It killed 200,000 people. It destroyed the buildings. All these, you lose labor through all of those deaths. You lose buildings, that's capital. You just see all this disappear overnight. Naturally, we're going to expect the economy to shrink as a result, right? Because we've just lost a major chunk of that economy. That's a real shock, something that's a sudden change in inputs, labor, capital, ideas. We can also look at this maybe as like tax policy, legal structures, real shocks that come from the government. So like changing tariffs, that's changing what we're able to have in the economy. Monetary policy shocks are sudden changes in the supply and demand of money. So a monetary shock might be gold entering or leaving the country when we were back on the gold standard. Venezuela printing too much money, hyperinflation. That's going to be another monetary policy shock. And these monetary policy shocks have significant effects on the short-run economy, but they have almost no effect on the long run. That's because in the long run, just in most monetary policy shocks, like I want to hedge myself when I'm saying this, but we can adjust to these over time. We have a huge shock in the money supply. Sure, we have inflation, but that inflation helps us adjust over time, and our output is fine. In the short run, though, these can be really important. And those monetary policy shocks are influenced by the Federal Reserve. Let me take a look at what we have right here. I have thoughts on Trump's stimulus plan in comparison to the one Bush implemented in 2008. We need this. So I actually am just finishing up editing a video that I'm going to post on Tuesday about inflation, deflation, the business cycle, what's going on right now, what we need. We really need money in people's hands. And so this stimulus plan that's coming out, we need it. It needs to be going faster. It might need to be bigger than that. The Great Depression, A Case of Tragedy of the Commons. Well, let's get to that. What's my favorite color? Obviously, blue. Actually, I had to change my shirt because I realized I was wearing the same blue shirt from last week's lecture. So now that these things are recorded, I have to be accountable for what I wear. And how long did it take for the Haitian economy to recover? Still recovering. In fact, it can't recover right now because they're in such a terrible situation right now. Wow. Okay. How does the Federal Reserve affect the economy? I just made a video about this yesterday. This was the video that you were watching if you're keeping up on market power. So I just made a video explaining the slides that are coming up. So this will act as a good review if you've already seen that video, and it will give you an opportunity to ask the questions you had after that video if you had any. But we're going to go through and we're going to talk about open market operations. We're going to talk about interest rates. We're going to give you kind of a general understanding of what the Federal Reserve does, because understanding what the Federal Reserve does is important for knowing what the Federal Reserve did not do during the Great Depression. So, oh, this is awkward now. I have recordings of me like scratching my back. There you go. So how does the Fed affect the economy? Well, the Fed's main tool to help the economy is using the money supply to influence interest rates. Remember, banks, we talked about this in the Panic of 1907. Again, if you're tuning in on this lecture because you're interested in just panics, depressions, recessions, I recommend going and checking out that lecture on the Panic of 1907, because we're going to go in that one, we talk about fractional reserve banking, we talk about bank runs, we talk about the establishment of the Federal Reserve. All of those topics are relevant for what's coming into the Great Depression. That's why we have these lectures right next to each other. So banks are required to hold a fraction of their deposits as reserves. They have to hold, today they hold 10% of deposits as cash on hand. Historically, some of the bigger banks were about 25%, as I mentioned in the Panic of 1907. The actual number isn't that important for what we're talking about right now, but just know that a fraction of those reserves are held by banks. And the question is, what happens if the bank doesn't have enough reserves? So you might have insufficient reserves. Let's have an example. I'm going to open up the Bank of Paulson. This is my bank, and I have one customer. It's my mother. She shows up on the first day and deposits $10,000. Thank you, very rich mother. And I take that $10,000, and through the day, I lend out $9,000. Somebody wants to buy a car, or, obviously $9,000 is not that much money to lend out, but I lend out $9,000, and I keep $1,000 for reserves, okay? Because that's what I'm required to. I'm going to say we have a 10% reserve requirement, so I'm going to hold on to $1,000 and lend out the other $9,000. Then, at the end of the day, just before the bank closes, my mom remembers she needs new tires for her car, so she withdraws $500. So her total deposits goes from $10,000 to $9,500. When the bank closes, there's only $500 in reserves. Because remember, I had held $1,000 and I had lent out the other $9,000. So I had $1,000. Mom comes in at the end of the day and takes out $500. So now I only have $500 in reserves. But I have $9,500 in deposits. And the reserve requirement is 10%. So that's $950. I need to have $950 in my bank against that $9,500. So the Bank of Paulson, first day of business, $450 short. Thanks, Mom. You came in supporting my business, and here you are putting me in trouble with the law at the end of the day. So how can I satisfy the law? My first day of business, I'm already below the reserve requirement. What am I supposed to do? I have insufficient reserves. Well, let's do the same kind of setup, but in reverse. Again, I'm opening my bank. Mom comes in at the beginning of the day to deposit $10,000. And instead of withdrawing $500 right before business closes, my mom actually deposits an extra $556. $556, Mom. Why would you deposit $556? Because, honey, you need it to make your example work really nicely. Well, thanks, Mom. You always have my back, even if you take out $500 at the end of the day. But today you have put in $556, so thank you. That means at the end of the day, my mom has deposited $10,556. Now, to have 10% of that Oh boy. Okay, I am back. That was scary. You know those moments in class when I just freeze up and I don't know what I'm doing? This is the internet version of that. Welcome to this fun episode. So, I don't even know where it froze, so let me just back up a bullet point. Total deposits at the end of the day, $10,556. The reserve requirement is $1,056. Can somebody let me know in the comments if things are going well? Because to me, they look like they're back to going on task, but I'm not sure. I'm getting some messages that they aren't. Oh yeah, I'm kind of getting skippy. I don't know. Whew. Let me know in the let me know in the chat if things are going well. Thank you, coronavirus. Anyway, so total deposits, once again, $10,556, and the reserve requirement is $1,056. That's 10% of that, right? Well, since the deposit came right as the bank closed, the vault has $1,556 in cash. Okay, I see in the chat people are saying it's back and good. Thank you. Let's keep this going then. So at the end of the day, I have $1,556. That's $500 more than what I need. Remember, I needed $1,056. I have $1,556. So I have $500 extra dollars. That's $500 I could have lent out. I could have been making interest, and instead it's just sitting in my vault doing nothing. What could I do with this $500 now it's the end of the day? It's just not making money for me. Remember, this money is only profitable for me if I'm lending it out and getting interest on it. So now it's just sitting there making no interest. I wish that there was something I could do. So this is where overnight lending comes in. We have banks with insufficient reserves. Banks that need, I think $450 was what I needed at the end of the night if I had insufficient reserves. So you have some banks that don't have enough reserves, and you have other banks that have excess reserves. So if I don't have enough reserves, I'd be willing to pay to get some money, because otherwise I'm in trouble. So if somebody were to give me money, I'd be willing to pay them a price just to let me keep it overnight to make sure I satisfy that requirement. And on the other hand, if I have excess reserves, I might be willing to let somebody borrow that money if they're going to pay me interest on it, because then at least it's out in the world making money. I'm getting something from that money. And so you have these two people. You have these two banks, one that doesn't have enough money and the other that has too much money. And so what we can do is get the bank with too much money, with excess reserves, to lend the money to the bank with insufficient reserves. And we have a market that forms, right? We have supply, we have demand, a market forms, and these banks lend each other money overnight. The interest rate on this money that's lent overnight is called the federal funds rate. And whenever you hear anything about the Federal Reserve targeting interest rates, changing interest rate, cutting, raising, anything about interest rates, we are talking about the federal funds rate. This rate on lending money overnight between banks. So the Fed influences the federal funds rate. That's their main policy tool. They have a few other things that they can do, but their main policy tool is targeting the federal funds rate using the supply of money to adjust it. So how does the Fed affect the federal funds rate? Well, the federal funds rate, we can look at it as the price of money. Is there, sorry, I just saw that this is a really good question. Somebody asked the difference between the federal funds rate and LIBOR. Federal funds rate is what's here in the United States. LIBOR is what's in the UK. So yes, they're the same thing, but they're in different places. Obviously, the Federal Reserve is not targeting LIBOR. LIBOR is happening out in the UK. So great question. Thank you for asking that. So if we look at these interest rates as the price of money, then prices are going to be high when the goods are scarce, and they're low when the goods are plentiful, right? So price high, interest rate is going to be high when there's not that much money and there's not that much excess reserves. And the price is going to be low when there are lots of excess reserves, right? So the supply of money is going to influence the price of money. It's going to influence the federal funds rate. Let me know if you have questions. I want to make sure that this is all clarified. It's really hard for me to know if you're confused or not. Usually in a live setting, I can read your faces and I can understand, maybe this isn't understood really well. One of the difficult parts right now, especially, is the lag, right? Like right now, I'm talking about this and you still haven't even heard my first question about whether you have any confusion, because there's a lag in between what I say and what you receive. So this is tough. I'm sorry about that, but let me know in the chat if you have any questions so that way I can respond to them. We're going to go through expansionary and contractionary policy. They're very intuitive once you understand that the interest rate is the price of money and prices are determined by supply and demand. Mostly with supply is what we're talking about here. Okay, there's my expansionary versus contractionary policy. Thought that I had left out some slides. We're good. So how does the federal funds rate affect other interest rates? So we're going to talk about that relationship between the federal funds rate and other interest rates, and then we're going to talk about how the Fed actually changes the federal funds rate. So the federal funds rate is the interest rate on loans between banks, not the interest rate that you get when you go to a bank and you want a mortgage or a car loan. So over here in this table, these interest rates I think are at least 18 months old now. The federal funds rate at the time was 2.25%. Oh man, that is bizarre to look at that right now. I cannot believe that was what it was 18 months ago. Just as a heads up, this last week, the Federal Reserve announced that they were changing the federal funds rate target to between 0 and 0.25%. Has it really gone down that much in the last 18 months? Wow, that's crazy. So federal funds rate at the time that I had checked these interest rates was 2.25%. A car loan for 5 years was 4.24%. A mortgage for 30 years was 4.875%. And if you just wanted a personal loan for 2 years, I think this is uncollateralized, it was 9.25%, right? So you've got this big range of interest rates, and none of them is the federal funds rate. So how does the federal funds rate come through and affect interest rates? Well, let's go back and think about the bank that I set up. And I lent out all this money. At the end, I was right at my line at 10%, which is something I want, but then that's a little scary, right? Like that's a little scary to be right there at the line because somebody could come in at the end of the day and take out that money. Now, obviously, I'm giving such a micro example that it's a little silly. It's a toy model, but let's work with it, okay? So if borrowers take out too much money, borrowers, depositors, if I lend out too much money during the day, I'll have insufficient reserves, right? Like that's too much is more than what I'll have available to meet the reserve requirement. If that's the case, I'll have to pay the federal funds rate on an overnight loan, right? Because now I've fallen below the reserve rate, the reserve requirement. I need to go get money from another bank. Well, if I have to get that money from another bank, I'm going to have to pay interest to that bank on an overnight loan. Well, think about what that means. If that interest rate is high, if the interest rate that I am expected to pay on overnight loans is really high, that can be an expensive thing for me to do, to be constantly borrowing on the overnight lending market and going to other banks and saying, please give me some money. I'm paying a high price for that. If it's a high price, then I might want to make sure that I'm not in that situation. In fact, I don't want to borrow on that market. I want to lend. I want to make sure at the end of the day, I have enough money to lend to other people. So that way I'm making a lot of money there. Well, how do I make sure that I don't have insufficient funds? Well, I need to make sure that people don't borrow too much money during the day. How do I do that? Well, I raise the interest rate. If I have a higher interest rate, that will discourage people from borrowing money. The quantity of money demanded will be lower in these car, mortgage, personal loan markets. They won't want to borrow as much money because interest rates are too high. And then I'll be in a position to lend that money on the overnight market, right? So if the federal funds rate is high, I would want to raise my interest rates that I give out to other people to make sure I'm not in that position where I have to borrow from other banks. Think about it on the other side. Let's say this rate is really low, like today, when we're targeting this really low federal funds rate. Well, If it's actually 0%, literally 0%, that means I can borrow money for free. If I fall below the reserve requirements, I can just go to the bank next door and say, hey, you had too much money. Will you let me have that money? And I can have it for free. Well, if I have free money available to me, then there's no point in keeping money in my bank. There's no point in me trying to lend to other banks. That's outrageous, right? Because I'm not making any money there. I want to get this money out to as many people as I can. Well, how am I going to get that money out to people? I'm going to have to lower my interest rates to get the quantity demanded up there. I need more people asking for loans. I need I need to give out more loans. So I'm going to lower my interest rates to get other people the money that will make me money, right? Like, even though the interest rate is lower, it's better than trying to make money on the overnight market. So you can see that there's a relationship between the federal funds rate and the rates that you receive, because it reflects the opportunity cost of the money that you have in your bank. The opportunity cost of the money that I have at the end of the day is however much I have to pay to get above the reserve requirement, or how much I will be paid for lending out the money I had above the reserve requirement. If I don't want to be in that position, like, I will adjust my rates to make sure I can lend out that money to other people. And so that's why you see there's a relation. Well, you can't see the relationship because I just have 1 month of data right here. But then you're going to have other things affecting your loans. A car loan has collateral on it. So does a mortgage, right? If you default on those loans, the bank can seize your car, the bank can seize your house. So those are going to be much lower than an uncollateralized personal loan, where they're going to have a really hard time getting their money back if you default. So they have a much higher rate on personal loans than on a collateralized car loan or mortgage loan. There are other factors that come in there, risk factors, all those kind of things, but they're going to be connected. It's not a one-to-one relationship either. Like, it bounces around a lot, but there is a positive relationship. When the federal funds rate goes up, car loans and mortgages tend to go up. When they go down, the reverse. One question is, why would banks agree to do overnight lending for 0%? Let's get to that in just a second, because it's not so much agreeing as it is that's just what the case is. Now, of course, let me get to that in a second. How does this work with payday loans? Payday loans, good question. Pretty similar to what's going on with banks, but payday loans are slightly different. They have really high interest rates on them. Let's get to expansionary versus contractionary policy, and hopefully this answers some of these questions. And you're going to see what the Federal Reserve does. This is how we describe what the Federal Reserve does. So now that you understand what the federal funds rate is, that's the price of money, we're going to look at how the Federal Reserve influences the price of money. When the Fed increases the money supply by lowering the federal funds rate, we call it expansionary policy. So think about this. Expansionary. We're expanding the money supply. So we're putting more money into the system. Because there's more money in the system, that expands the economy. Why does it expand the economy? Because the interest rates are lower. You've increased supply, so that's going to drop the price, and therefore you drop the price of the federal funds rate, you're going to drop the price of car loans, right? Like, before, I wasn't going to get a car loan, or I wasn't going to get a mortgage. Now it's cheaper for me to get those things, so I go out and get more of them, right? So now the economy is expanding. There's more activity going on. On the other hand, when the Fed decreases the money supply by raising the federal funds rate, we call it contractionary policy. So they're taking money out of the system. It's contracting the money supply. And by contracting that then will contract the economy, because interest rates increase, people invest less, right? Money is scarcer, it's more expensive, therefore interest rates on houses and cars are going to go up. If interest rates go up, I might decide to not buy a car, to not buy a house, and if that's the case, the economy is not growing as much, or it is contracting a little bit. Let me just give you a quick diagram of what's actually happening here. I brought out my whiteboard. Let me make sure that you can see this. Okay, you can see it. I'll make sure that I put it right there. Let me just diagram this out. Usually I draw on the monitor, but we're going to have two banks. Okay, here's two banks. Always got, okay. And then here's the reserve requirement. And this bank has excess reserves. This bank has insufficient reserves. And so what would happen is this bank would send cash to this one to help it cover overnight, and this one would go back, and the next day would give back the cash with interest, which we'll say R. Okay. You have the price right here. This is the federal funds rate. That is determined by the supply. Now, obviously, there aren't two banks. There are multiple banks in this economy. So if there are a lot of banks with excess reserves, that's going to be low. The interest rate is going to be low because there are a lot of banks willing to lend out that money. So you have that. Oh, I should have thought ahead and grabbed an eraser. So you have these banks. So I'm going to draw them down here. And then up here, you have the Fed. Okay. The Fed is going to deliver money. Let me just get rid of this PowerPoint for a second so that way we don't have to worry about how this is positioned. When the Fed wants to put money into the system, it doesn't just throw money into the system. It's not just printing money and putting it in there. It's also taking something out of the system. The banks give what are called T-bills. These are treasuries. Sorry, hit that for a second. These are T-bills. This is government debt. So banks are holding government debt, and the Fed is buying this debt from them. So if you watched my video on the Fed injecting money into the system, I talked about how banks are like a pitcher of water, a pitcher of ice water. Ice water has ice and water in it. The water is like the cash, and the ice is like T-bills. Remember when we talked about liquid versus illiquid, or we talked about illiquid versus insolvent, and we talked about illiquid. This is in the lecture on the Panic of 1907. Illiquid meant that you had money, but it was just frozen somewhere. You needed time for it to melt. That's what a T-bill is. A T-bill is like ice. It's almost as good as money, but it takes time for this to turn into money. And so what the Fed will do is they'll buy this. So this is good asset. This is like the most secure asset there is. It will buy this from the banks, and in return, it will put money, more cash into the system. This is called open market operations, OMO. Okay, so they're putting dollar bills into the system, and they're taking T-bills out. Then, if they want to contract the money supply, it will go the other way. They will sell the T-bills they have and bring for cash, and the cash will come out. The Fed will take that, and money will come out. The interest rate will go up. Okay, so that's how the cash is actually coming in and leaving the economy, is that the Fed is buying and selling treasury bills. That's called open market operations. Hopefully that diagram worked. Someone asked, how can money melt? So it's a metaphor. We are currently teaching my 8-year-old about metaphors. That is a metaphor. Money does not actually melt in this case. It's a T-bill that will turn into money with enough time, and today we just pay cash for it. Okay, let me get my PowerPoint back up. There we go. We are going to get into the conditions leading up to the Great Depression. We just got a question, how did the stock market crash? We are going to get into that right now. Let me make sure that I've answered all the other questions. Why would banks agree to do overnight lending for 0%? When the Fed targets interest rates, they set up a range. So the current range that was set, was it just this last Sunday? This last Sunday or the Sunday before, it was between 0 and 0.25%. The Fed can't get exactly, prices are going to vary. They're going to try to keep it within that range. It won't ever, sometimes it hits 0 actually. There are complicated reasons why it would actually hit 0, or it could actually go below 0. The idea is the banks aren't going to, most of the time, literally take 0. They might take 0.1%. because it's just an overnight loan, right? This is just for one night. Hey, 0.1% overnight is better than nothing, so we'll lend this money out. That's why they'd be willing to do it, is because it's better than any other opportunity that they have. Okay. Why did they drop the federal funds rate? Great question. The Fed recently dropped the federal funds rate because they're doing expansionary policy, right? They want more money in the system. They want more people to have access to credit. Businesses are potentially going to fail because they don't have enough demand. Restaurants don't have people coming in. You have bowling alleys that need people. They don't have people coming in. You have all these issues. And so to get through those times, these businesses are going to need loans. Well, to get those loans, oh my gosh, Primer is in here. Guys, I have to take a second. I'm never sure if it's Primer or Primer, but I am so excited that you're in here right now. Thank you so much. Can a bank... Oh, okay, sorry. Let me get back to this. I just saw this and I was super excited that he's in here. So, I'll get to your question in just a second. But the reason why you would lower this rate is so that way these businesses that are possibly failing and need loans to cover that time, they will get loans at really, really low rates. You don't want them to have super high interest rates because then it's going to make it even more difficult, or you might make them reluctant to go out and get their loans. So you want to lower interest rates as much as possible. Can or would a bank say no to buying or selling T-bills? Yeah, absolutely. So this is a market, and so they're essentially just they post auctions, I believe. They're doing some sort of auction process. I don't know the exact mechanism, but essentially it's a free market, and the Fed says, we want to buy this many T-bills, and they say, here are the prices. This is how much. We have some sort of supply and demand type function that would say this is how many T-bills are supplied. Actually, Primer, I'm so sorry. Since you asked this question, you guys should check out his simulation. You are more than welcome to drop in your link to your video on simulating supply and demand, because it's a very similar process there. Though at one point, one of the curves is mislabeled. You call the supply curve demand curve or demand supply. I can't remember which one it is. But other than that, it's a fantastic video that will show you how a simulation of supply and demand to reach that price. Same thing happens in this market. Basically, the Fed says, we want to buy this many bills. They put up an auction, and you have as many people submit their bids, and then they have a market clearing price that says, this is what the equilibrium price is. This is what we're going to sell them at. So yes, they could say no, and the price would be higher, but some other bank would take it. Great question. Let's get into the conditions leading up to the Great Depression, because this is, to understand what caused the Great Depression, this will be important. And when we get to the Great Recession at the end of the semester, this is going to be really key. You're going to see the parallels here so much. Same with the Panic of 1907. Go there. Oh man, that's why I love doing these lectures, especially with the recession that happened in 2008. You're going to see the parallels so much. You're going to see how they connect. So what were the conditions leading up to the Great Depression? So we often call this time the Roaring Twenties. Whenever I hear the term Roaring Twenties, I think of The Great Gatsby, which maybe you hated that novel in high school. I recently reread it. It is fantastic. I really enjoy this novel. It's worth a reread. I hope you go back and check it out. But some people will say the Roaring Twenties were not actually like the Roaring Twenties. It's not like there was this like crazy uplift in living standards, whatever it is. But we're coming out of World War One. We've actually just overcome the Spanish flu of 1918. This is this big. It's actually bigger order than what we're dealing with right now with coronavirus. So we have all these like crazy events that happen in the 19-teens, and we get to the 1920s, and we have relative prosperity. We've got new inventions, we've got cars, we're starting to do master flight. We're getting all of these big advances that are bringing us into a more modern economy. And it's a time full of optimism. I guess I just kind of went over all this. World War I's over. We have all these big innovations that have changed. The middle class is growing. People are buying stocks for the first time. And even Ladies' Home Journal is giving financial advice. And I can't even imagine what Ladies' Home Journal was writing about in the 1920s. I guess I should go back and see what their other articles are. It's not that much of, I don't know. I just imagine it's like, here's the best way to clean or whatever it is. But along with that, they're publishing articles like you should be buying stocks. They're telling these housewives, buy stocks, get in the stock market. People are just really optimistic about how things are going. And that optimism leads to a thriving stock market. It's fueled, and that thriving stock market is fueled by margin purchases. Let me explain what margin purchases are, because this is what will help us understand how the stock market crashed in 1929. So a margin purchase is when you get a loan to buy stock and you use the stock as collateral. So think about when you buy a house, you go into debt, you buy this house and you put up the actual house itself as collateral. So that way, if you fail to pay your loan, you will get that house back. The bank can get that house to cover the loan that you didn't pay. So this can be an attractive option because your profits are much higher when you use margin purchases. And let me go through how ridiculously tempting this is. Let me expand this to make sure that you can see exactly what's going on here. Let's say that you want to pay cash for 100 shares of a $50 stock. So that's going to cost you $5,000, right? Well, then the stock rises to $70 and you sell everything. You just sell all of it, all 100 shares. That gets you $7,000 in revenue. Now it costs you $5,000 to buy those stocks. You get a gain of $2,000. Great, good news, right? Well, let's think what happens when you buy on a margin. So when you pay pay cash for 100 shares of $50 of stock, you're gonna get $5,000. Now you could put those 100 shares as collateral. Well, you can put that as like the down payment in a sense, and then blend out a whole bunch more money. Let's say you buy another 900 shares on margin, and that costs you nothing initially, right? You're getting debt. That's $9,000 worth of debt that you're gonna get out there. But right now it costs you nothing to do that. The stock rises to $70. So to be clear, you have 1,000 shares of stock right now. It costs you $5,000 to get that. Your stock rises to $70 and you sell everything. So you sell that 1,000 shares of stock for $70 per share, you get $70,000 in revenue. Now, that $70,000 is not all yours because you have to repay that margin loan with interest. Now, you bought 900 shares at $50 a share, so you took out $45,000. Let's say that you paid $3,600 for interest, so you have to pay back $48,600. But even after paying back that loan with interest, you get $16,400 in profit. Keep in mind here, you only spent $5,000 in both cases. This is crazy, right? In one case, you pay $500,000 in cash and you get $2,000 gain. The other one, $5,000 in cash, but because you used the loan to get more stocks and then you paid back that loan, $16,400. You have octupled your profits just by taking out a loan. Now you can see why this would be an attractive offer. You can see why this would be amazing. Usually, if we're in person, I've got people in there thinking, oh my goodness, this is crazy. Okay, I have a question in the comments. Explain why buying another 900 shares costs nothing. The cost comes back here when you have to repay your loan with interest. Okay, so at the first, it doesn't cost you anything. You're buying it on margin. But then the cost comes when you pay it back. That's the point, is that you're paying it back in the future. So this is the first day, whatever it is, you don't have to pay. Then in the future, you're paying it back. And that's when the cost comes in, is right there. I see that in the chat as well. People are explaining that. So hopefully that's clear. So what you're saying is that we should buy stock on a loan with the stock itself as collateral. I'm not saying that you should do that. What I'm saying is that is what is happening here. But let's go through. Oh, you can't even see. I'm gesticulating. You can't even see me because I've got this so big, huh? Let me shrink this down. Let's see where. There we go. So, okay, here we go. We're back. You can see me gesticulating. So here we have the stock market. This is the Dow Jones Industrial Average from 1920 to 1929. Now, when the stock market is rising like this, when I think of the Roaring Twenties, this is what I think of as the roaring, like the stock market is just roaring at this time. When you know that the stock market is rising like this, purchasing on margin is fantastic, right? Like you can make easy money doing that. And this is, foreshadowing for what happens in 2008 is that if the housing market is rising like crazy, it's fantastic to buy a house with a ton of debt, right? Because you're going to be able to pay off that debt really quickly. So if you have a rising stock market, fantastic time to be buying on margin. But let's go through the risks, okay? What is the risk of margin purchases? I'm going to leave this up here like this because I'm gesticulating a lot and I want you to be able to capture the full emotion that I am bringing to this. So you have a huge upside, but if the stocks fall, you could lose everything. So we're going to start off with the same initial situation. You buy 100 shares of a $50 stock. So you pay $5,000. But then the stock falls to $3,000. Well, the stock is falling. You're worried about it. You sell everything. So you sell for $3,000. You have lost $2,000. Okay? Sad. Probably not the end of the world. Let's go again and buy on margin. We buy those first 100 shares at $5,000. Then we buy the next 900 on margin. We're taking out a loan. The stock falls to $30 and you sell everything. Okay, so now you sell those 1,000 shares for $30 a share and you get $30,000. But remember, you have a loan of $48,600 to pay off. So after you take into account that you had to pay off that $48,600 loan, your profit is negative $23,600. Huge losses, huge losses. In fact, the losses here are potentially infinite here. Let's see. Your losses are limited when you have when you're buying by cash, right? The most you're going to lose is $5,000. I mean, this thing is basically unbounded as they go out, and you can lose so much money if the market tanks. This is incredibly risky to do this because you can lose so much money. So the problem comes when you buy the shares with a loan and the market price drops instead of climbs and you're unable to pay back the loan because you don't turn a profit. Yes, absolutely, Emma. That is exactly what the problem is. Things are great if the stock market goes up. You're going to make tons of money. You're going to make out like a gangbusters. You have the potential to lose so much money if the stock goes down. Even if it just goes down a little bit, you can lose so much money. That's where margin purchases become crazy. So you have to, very risky strategy, okay? So that's the conditions leading up, right? Things are doing pretty well in the 1920s. Yes, shorting is definitely infinite loss. That's why I'm getting confused. I think your losses might be still bounded under margin purchases. Not 100% sure, but for sure on shorting a stock, you have theoretically infinite losses. So that's what the condition of America was in the 1920s leading up to the Great Depression. What actually caused the Great Depression? I am surprised at how I'm getting through this lecture. Look at that. I still have good 20 minutes. Hopefully I have enough time to get through this. Okay. I like to compare the Great Depression to psychological depression. People stopped spending money, which caused businesses to close, which made people afraid to spend money. Like the big cause of the Great Depression is people just stopped spending money. And we're seeing that today, right? We're seeing people stop. They're not spending money today because there's this worry about going out into the world and being infected by this disease. But that's the nice thing about what's happening today is once we get the virus under control, once we know that people aren't going to be infected, we're going to immediately pick up, we're going to start spending money again. In fact, we might spend money that we weren't spending before because this is an opportunity to get out there and to make up for lost expenses. This is called a drop in aggregate demand. Demand has dropped because people aren't spending as much money. Well, why? Like, really what happens in the Great Depression is you just say, like, the Great Depression wouldn't have happened if people had just started spending money again. Like, there wasn't really, like, this fundamental thing other than just spend a little bit more money, people. just snap out of it, right? But that's like telling somebody with depression, saying like, trying to solve it and saying, just have you tried not being depressed? Like, just be happy and you'll be fine, right? Depression is a complex biological, psychological condition that sometimes needs medication, it needs intervention. There are things that come into depression to get you out of it. I like to describe the Great Depression as starting with an anxiety attack, but becoming a full-on depression because the Fed failed to deliver the medicine. So the Fed is scared of a stock market bubble. In 1929, they're worried that there's this big bubble, the stock market's going to crash. And so the New York Fed raises the federal funds rate to discourage loans for margin purchases. Now, quick aside, the Federal Reserve today does not work the same way the Federal Reserve worked back then. You had all these individual branches that had much more autonomy. And so the Federal Reserve in New York had the opportunity to intervene. And we'll actually get into that a little. I think this is in the next lecture. So this is the first part, by the way, of the lectures on the Great Depression. We're going to talk about recovering from the Great Depression on Tuesday in that lecture. So the Fed intervenes. They try to raise interest rates. They're trying to discourage people from borrowing so much money to buy stocks. And despite the Fed's actions, the market actually keeps rising, right? Like that graph just keeps going up. And so the Fed is not omnipotent. It can influence the economy, but it doesn't control it. Then we have the stock market crash of 1929. Here's an actual picture. The crowd gathering outside the New York Stock Exchange. Black Thursday, October 24th, 1929. These things typically happen in October. Remember, Panic of 1907 also happened in October. When we get the Great Recession in 2008, that also happens in October. I don't know if there's a reason why this all happens. So Black Thursday, October 24th, 1929. The market hiccups. There's this this quick thing where all of a sudden it drops 11%. And like in the Panic of 1907, which we talked about last time, bankers rally to prop up the market. They realize, oh my goodness, this is going to fall. The slide stops and it rallies through Friday. But then you have the weekend. And that's when you have all this time for people to realize, they're getting the news. They're hearing about what's happening. They're like, oh my goodness, what just happened? And so on Monday, October 28th, they all show up and you have all these margin purchasers. Now think about these people who have purchased all this stock on margin. If that stock goes down, they have potential to lose so much money. And so what do? You want to get out of that game as soon as you see the prices are going down to make sure that you're not in debt to the order of tens of thousands of dollars. So the margin purchasers start selling off their stocks to stop the losses. But what happens when everybody shows up to the market and starts selling their stocks at the same time? Prices are going to drop, right? We just have this huge shift in supply. Supply increases, prices are going to drop. And because so many of these people are selling, stocks plummet, and that creates an incentive for more people to sell, right? Like, oh my gosh, I have to get out of this. I have to sell. And then the market again on Monday loses 13%. Slide continues into Tuesday. Market loses another 12%. We're just seeing the market go down, mostly because all these people who had purchased their stocks on margin, who had purchased their stocks using debt, needed to sell those stocks to get it out of that situation and not lose their money. But it becomes a self-fulfilling prophecy. It's a crazy situation to be in, right? So I showed you this first part of the graph and how the stock market was just increasing like crazy. And then we have this massive drop. And then we have this little bump. We have a little recovery, and it continues to slide all the way into the 1930s. We're going to talk about this recovery right here on Tuesday and how we get out of this. But what you need to know is, wow, we have this big drop. A lot of people, when you ask them what caused the Great Depression, they're going to say, well, it was the stock market crash. Stock market crash is a contributor, but is not the main cause. In fact, you can see right here that we start getting out of the stock market slide, right? We have this little recovery and then it goes, right? So the Fed does nothing during this. The Fed thought the stock market was overvalued in the first place. They're like, look, this is great. The bubble's popping. This is going to get things through. Even tried to reduce the crash earlier in the year. The New York Fed does move to help, but the Federal Reserve Board in Washington says, maybe we shouldn't be stepping in right now. By 1930, it looked like things were good, right? Like that's this arrow pointing here, right? Things might be fine, but then the slide resumes. Why does the slide keep on going? This is where bank failures come in. The recession was bad, but it looked like things were recovering in the second half of 1930. Then banks began to fail, similar to what happened in the bank panic of 1907. Remember, people are worried that their bank is going to fail, and if that bank fails, they're going to lose all of their money, right? We don't have deposit insurance at this time. If this bank fails with your money in it, you are not getting that money back. This is the toilet paper runs, right? If you need toilet paper and Costco doesn't have toilet paper, you are now out of toilet paper, right? If that's the case, you want to make sure you get to Costco first to get that toilet paper. So that way you're covered during this time. Same with banks, right? If your money is about to go out the window, you want to make sure that you're one of the first ones at that bank to make sure that you at least get some of your money back. But if everybody does that at the same time, it becomes a self-fulfilling prophecy, and that bank actually fails. So people begin losing confidence in the banking center, and instead of depositing their money, they begin hoarding their cash instead of depositing it. But because they're hoarding it, they're reducing the money supply, they're increasing deflation, they're causing all these problems. They're not spending their money. Oh man, we talked about the deflationary spiral in the panic of 1907, but basically you have deflation, people aren't spending money. Because people aren't spending money, businesses lose profits. Because businesses lose profits, people lose their jobs, and because people lose their jobs, they stop spending money, and that spiral goes again. Here's a line for a bank run. That's just, you can see this thing stretching all the way around the corner. People are just trying to get their money from the Bank of the United States right there. People are worried. And it's not just the collapse of the financial sector. It's not just people losing their money there. Remember, banks are tinder for money, right? They're trying to match money from savers to investments from borrowers and trying to make the most of those opportunities, trying to make money off of that, right? They're matching these things. When you find, and like Tinder, you want to make sure you get a good match. You want to find somebody that's reliable. You want to find somebody that's going to keep their dates, right? You want to find whoever you can. When a bank fails, all the research that it's done on its clients disappears with it, right? So imagine you have a loan with a bank and your bank fails. Well, you still need money to go out and keep your business running. But the problem is now when you go to a new bank, they don't know, were you a good customer or a bad customer at that last bank? Are you not surviving right now because that bank failed, or is it because you're just bad at business? And so it becomes risky to take on all these new customers, especially when you're worried that your bank's about to fail. You don't want to lend out more money to these people. And so you lose all this information in the economy. This is like this really bad system, not bad system, like the system is what it is. But to have these banks fail when these relationships, when this information was so crucial to making things work, that can be really bad for the economy to recover because you lose that. Everything just keeps spiraling out of control here. Finally, there's gold pressure. So we're talking about three main causes of the Great Depression. The first one is the stock market crash of 1929. The second one we're going to say is bank failures. And the third one is gold pressure. Remember, right before we switched to online lectures, we talked about the gold standard and the effect of deflation. Gold is leaving the country. Great Britain leaves the gold standard in September 1931. Everyone's on the gold standard. Basically, everyone's on the gold standard at this point. Great Britain jumps ship almost immediately. Foreigners holding dollars, American dollars, become afraid that the U.S. is also going to leave the gold standard. And if they leave the gold standard, then suddenly these dollars aren't worth as much as they used to be. So to save their investments, to make sure that they have value still, they convert their dollars into gold, and gold starts leaving the United States. Well, since gold leaves the United States, we get deflation in the United States. We get all these deflationary pressures. Do I have the graph right here? Yeah. Here is the price level leading up to the stock market crash in 1929, and then you just have massive deflation over the next 3 years, right? Prices are just plummeting. And just like I said, there's a deflationary spiral, right? If prices go down, it increases the real value of your debt. It discourages future investments. You have all these problems that come from deflation. As much as we don't like inflation, deflation like this is awful. And this deflation is tightly connected to the fact that the U.S. was on the gold standard at the time. Yeah, here's the reminder. Deflation increases real value of debt, discourages future investment. The Fed is worried about losing this gold. They need gold in the country for their money to work. And so they raise interest rates to try and keep gold here. But what do higher interest rates do? they're going to discourage investment, right? That's a contractionary economic policy. They're doing the exact opposite of what they should be. They should be expanding the economy. Instead, they're contracting it. And so this just leads into this spiral. Everything just keeps going down, down, down. So it's this perfect storm. You have the stock market crash, you have the bank failures, and you have the drain on gold, which leads to deflation. All while the Fed did nothing or acted the opposite way it should have to help the economy. And that the irony of all this is, if you remember from the Panic of 1907, the Panic of 1907 is this economic crisis that happens, and we realize we need a way to respond to economic disasters. This is the moment that the Fed has been created for. Like, this is the Fed's time to shine, and they do the exact opposite. In fact, there's this question of, would we have had a Great Depression if the Fed had not done all of these things? Yeah, it is crazy. They totally dropped the ball on this one. Why didn't the Fed act? This is when I want to emphasize how much we talk about models, right? It's so important for us to understand economic models. We need to understand where these, how we think about the world, what the causal mechanisms are. And the people in the Federal Reserve had the wrong models of how the economy behaved. They had this model called real bills that said you should not intervene to assist failing banks, essentially, which is the opposite of what we call today sound monetary policy. They also believe that when the economy was contracting, you needed to take money out of the system, and when it was expanding, you needed to put money in. Just the exact opposite of what we know today is sound monetary policy. Another is liquidationist. This is that recessions help the economy by pruning the inefficient firms, right? This is like a survival of the fittest type idea, that recessions come, they weed out the weak. The long run economy is healthier because of a recession. And again, this is a policy of non-intervention. So these are two models that the Fed has in mind about how the economy should work. And neither of these models say you should intervene in the time of economic distress. And so this is where it's really important for you to understand that economics, economic models, the models that we have of the world, are so important to the actual way that we live. Like, if they had had the right models in mind, possibly we could have avoided the Great Depression. So that's why I focus so much on making sure you understand the economic models, make sure you understand the assumptions that go into it, make sure you understand what we need to do based on these different models. Could the Fed have done more? You know what? For the sake of this lecture, I'm going to skip these two slides. I'm going to skip that one slide because I only have 7 minutes left, and I want to get into real shocks. What about real shocks? So far, we have discussed just these monetary policy shocks. We've discussed banks failing. We've discussed the stock market. We've discussed all these things where monetary policy is failing. That is the consensus, is that is what caused the Great Depression, were these monetary policy shocks. But that doesn't mean that real shocks didn't play a role. And there are two real shocks that we need to understand. Let me get a quick look at the chat to make sure that we're up to date on things. Does it concern you that the Dow has dropped by 5,000 points since last month? Yes, that is concerning that the stock market is dropping so much. That's why we've been needed to act so quickly. With the concerning part, like the Fed has been acting so quickly. They're doing so much. The big concern is that Congress is hardly doing anything at all. Going back to one of the earlier points, it seems like monetary shocks can have long-run effects because they impact how real shocks develop. Is that right? Yeah, so monetary policy shocks have the potential to have really long shocks. I mean, I guess this is where we talk about like how much is long run. Like, as you can see, we have these monetary policy shocks causing the Great Depression, but then we have the recovery. But if you look at like a country like Zimbabwe or Venezuela, where these monetary policy shocks of hyperinflation have really big effects today, they can then translate into things that we didn't do today that could have helped the long run economy. So I might be speaking too loosely when I say they don't have big long run effects, but mostly like if we have inflation, we can adjust to it. If we see that we actually adjust to these things. But of course, there are still real costs that happen during this time. During these last few minutes, let me get to the Hawley Smoot tariffs and the Dust Bowl. So Hawley Smoot tariff was a tariff bill that was passed in 1930. The question is, the tariffs were passed before the Great Depression. So what was the goal? Now remember, if you know the 3 R's of trade, revenue, restriction, and reciprocation, you know that we're in the period of restriction. So these are restrictionary tariffs. These are restricting goods. They're protective tariffs. So this is increasing tariffs, which again, oh my gosh, I'm just realizing the connection here we have today, where we have similar protective tariffs that could possibly be exacerbating the economic situation we have right now. Fantastic. So this bill increased tariffs on more than 20,000 imported goods. And the original goal was to shift protectionism from manufactured good to agricultural goods. But of course, politics comes in and interferes. Now, the Hawley Smoot tariffs, one of the Smoot there, here we are at Utah State University, so I like to point out that Reed Smoot was a senator from Utah from 1903 to 1933. He is the Smoot on here. What's interesting, being from Utah, he was also in high-ranking leadership in the Church of Jesus Christ of Latter-day Saints, so he was an apostle from 1900 and 1941, so he served both in the Senate and as a high-ranking church official at this time. In fact, after he was elected, he faced a 3-year hearing on whether he was eligible to be a U.S. senator because of his church membership. So there's a little bit of Utah history for you, and you're going to see Utah history coming into play in the next lecture as well. So a lot of people for a long time thought that these tariffs caused the Great Depression. And it makes sense. The timing seems about right. Like the tariffs are passed right when everything goes down. And it was a large increase. But Doug Irwin, who's an economist at Dartmouth, he's done a pretty convincing job of showing that the magnitude is infeasible. Trade was only about 1% to 2% of GDP. So even a significant reduction in trade could not have had such a large effect on the economy. In fact, the tariffs might have helped. They probably didn't help. They could have helped by bringing more demand to the domestic economy, right? They're protective tariffs, so they bring demand, they increase demand in the domestic economy. So it might have actually even helped. Pretty crazy that we just don't know really what the effect of the tariffs on the Great Depression was. Economics is hard, guys. Finally, let's talk about the Dust Bowl. This image, oh my gosh, I just can't even imagine seeing with this. So the way to compare that, it's not quite, but here in Utah, we just had an earthquake yesterday morning, right? We have all this crazy stuff going on with the pandemic, and then on top of that, we have the biggest earthquake in like 30 years in Utah. And it's just like, if that had actually done some serious damage, actually did around Magna, the epicenter, there was some serious damage. Man, it's like just layering on all this kind of stuff. Dust Bowl, same way. The Dust Bowl destroyed agricultural productivity. Here's a picture of a farm during the Dust Bowl. It's basically a beach. Like, you see that cow back there on this farm. I just can't even imagine trying to grow any sort of crop on this. Yeah, I mean, the Dust Bowl is insane. So the whole country was affected. These storms that happened in the Great Plains would carry soil all the way to New Hampshire. Insane. Dust storms affected more than just agriculture. They had huge health problems. We have some good research that show that this had serious effects on people's health. They had serious damage to property, just all these bad outcomes. And of course, there's a migration response. This is what the Grapes of Wrath is about. People leaving Oklahoma and migrating to California. You have 2.5 to 3.5 million people leaving the Plain States because of this. Well, what caused the Dust Bowl? Remember homesteading. Remember, this is one of my favorite things to connect back. We talked about homesteading at the beginning of the semester. The primary objective of homesteading was protecting property by creating dense settlements of small farms, right? We were worried about property rights being attacked, and so you put all these people in a relatively small area, put them all on small farms, make sure that they're there to protect each other's property. But for erosion control to be effective, you have to implement this on a pretty large scale on large properties. And if you're on small properties, if you implement erosion control, but your neighbor doesn't, then you're going to incur a high cost and no benefit, because one farm doesn't accomplish much, right? You can do all of that and it wouldn't affect anything. And so these farmers need to cooperate to get this erosion control implemented, but that's really hard to do over hundreds of farmers. Like, everybody do this thing. Everybody can take on these huge costs to stop this potential environmental disaster, and yet that's really hard to do. If only there was an analog to some sort of impending environmental threat that takes more than just one person acting. Anyway, thus, homesteaders underinvest in erosion control measures, they overfarm, and when the drought hits and winds hit, the topsoil is just swept away. All right. In conclusion for today's lecture, the primary cause of the Great Depression was the Fed's resistance to counteract monetary policy shocks. Yes, there were some other things that made the Great Depression worse. We had the tariffs. Again, we don't know the total effect of the tariffs. And we have the Dust Bowl that's just going to be like on top of that. But mostly what happened was the monetary policy shocks. And so Tuesday in our lecture will be at the same time. We're going to go over recovering from the Great Depression. We'll talk a little bit about the New Deal. We're going to talk about what the Fed did to overcome these shocks. But that's it for today's lecture. I really appreciate you guys joining me today. I know this is difficult to go through everything, what's going on. Hopefully you benefit from this. If you have questions that I wasn't able to answer here, put them in the comments. I'll be monitoring comments, or my TAs will be monitoring the comments, so that way we can make sure that your questions are answered and that you understand what's going on here. Please review this material. Please make sure you're up to date on this ahead of Tuesday's lecture, because we want to make sure that you understand how we recovered from it. Also, check out some of the other videos that I've done on these kind of monetary policy issues, because they can help you understand these questions. They can help you get an idea of what's going on today. Really appreciate you guys being here. Thanks so much, and we'll see you on Tuesday.